Hi, I wanted to talk today about marketing and how we monitor what we spend on both new customer acquisitions and also returning customer retention, both of which I think are really, really important for Huddled. I was recently asked by a shareholder what did I think the potential was for Huddled Group and what the barriers were to growth. My answer, which to be honest, I've given many times before, is that I think each of our brands is only just starting its journey, and the amount of surplus stock that is available is massive. Customer demand is high, and to be honest, I think it's never been more relevant in where we sit today, whether that be for sort of packs of Mars bars, Brewdog beer, craft gin, Grenade protein bars, Gucci lipsticks, Tom Ford perfumes. I mean, ultimately everybody wants a bargain. They all want to buy something for less, so I think we're bang on in terms of that. That said, we're very cognizant of the need to move the business into profitability and to achieve this within the cash reserves that we have. And as such, we have to temper our ambition to grow new customer numbers whilst ensuring we retain and nurture our existing customers. So with the new warehouse improvements that we've made, we're now in a position where we can look to build on the level of monthly orders. But this needs to be a mix of both new and returning customers, with the aim being to tip the balance in favour of returning rather than new as soon as it's practically possible. So this is something that we monitor absolutely every single day. So look, let's just look at each of the brands individually, and then we can sort of unfold what that means for each brand as we get into them. As most of you are aware, Discount Dragon has grown rapidly over the last 12 months. And whilst we've added a lot of new customers, we're now starting to enjoy the benefit of returning customers coming back in their droves. So over the last 12 months or so, we've seen the percentage of new customers versus returning customers fall, and that's fallen quite sharply over those 12 months, with the percentage of new customers now falling to a level we're really happy to sort of maintain at sort of circa 30%. And as this balance tips in favour of existing, our marketing strategy gets more honed, and we're able to divert some of the cost of acquisition marketing to retention marketing. And whilst this is only a fraction of what it is compared to the acquisition marketing, it's still something that we need to spend. But as the balance tips in our favour, we can then sort of, as I said, start focusing on retention as much as acquisition. So with this brand, really it's now about maintaining that target level of sort of circa 30%, whilst growing the overall order levels in line with our increased ability to sort of process more with the additional warehouse floor, etc. So, and as I discussed some weeks ago, the cost to acquire a customer, which is important to know, is often more than we make from their first visit or their first order. But on the basis that they do return, then over time this balance shifts, and as a percentage of new customers versus old reduces, then the more the operational gearing kicks in. So hopefully that's sort of becoming more and more obvious as we sort of get into things. So on top of acquisition and retention marketing initiatives, we also run a number of other initiatives, additional sort of marketing layers that help drive up the average order value. And this is something else that's really important to us. But more importantly, absolute margin, and it's about that absolute margin that we're focused. So it's always a balancing act, one we're getting better at. The more we do it, the better we get, really. And in my opinion, there are two things that really matter, and I believe this applies to most businesses. The first is what we call the CPA, the cost per acquisition, and the second is what we call LTV, which is the lifetime value, so the lifetime value of a customer. And if we can get that balance right, sooner or later the operational gearing kicks in and we can drive operational profitability. So just moving on to NutriCircle and where are we with this brand. And as most of you are aware, this brand has grown a lot over the last 12 months. And it's worth remembering that in 2024, it did circa 1.6 million in revenue, whilst in March this year, 2025, it generated over £435,000 in a single month. And in March, new customers versus old were at 52.6%, albeit this has fallen from the big push that we did in January, where it was around about 58%. And this month we're trending at sub 50%. So you can see the trends going in the right direction in terms of the balance of new customers versus returning customers. On Boop, this was a fledgling business. So in December we were just at below 72% new customers versus returning. And as I said, why? Well, it's a brand new brand, and we were growing this from almost zero. So new customers were always going to be, almost 100% of where we started. But what's interesting, in March, we saw orders exceed that of January and February combined, yet, and this is the important fact, the percentage of new customers versus old was down from 72% in December to 63.7% in March. And in April, it's actually fallen to below 60%. So you can see again, that's trending in the right direction. So in summary, we can see that our customers are coming back. And whilst we're still adding plenty of new customers, the overall percentage of new customers versus old is going in the right direction. And this is really important for that operational gearing to sort of kick in. We also know, as I've said many times before, that demand is plentiful and we're confident on stock. So with the warehouse improvements now resolved, it's really about growing the total number of orders across the brand to deliver that operational profitability. Something that every member of the team is 100% focused on. So yes, look, we continue to have daily challenges, but I mean, really, name me a business that doesn't have these.